Average house price Average house price sales in central London have already fallen between 14 and 20%. Those that study the market or have been in it for a while are aware that the market is far from rational. In fact, the market is driven by human sentiment. There is a good book called Predictably Irrational by Dan Ariely, who delves into this matter further, and it is arguably one of the most important books I've read. Anyway, this isn't a blog, so let's dive into the UK housing market. So us humans always expect cause and effect and assume that if house prices are falling, it is because of a fundamental reason. This is a hard pill to swallow. However, this claim is false. We can notice this mostly in cryptocurrencies. And if you're into crypto, you'll realize the herd mentality associated with the space and general sentiment right now is that the bull run is back. However, the majority of the gains have already been made. The point I'm making is human emotion can often create an echo chamber which causes severe losses which some may have experienced. So with this in mind, the best way to distinguish what is actually happening is to look at the charts. Every now and then I will put some figures in which might have been in the news as people find comfort in knowing that there is a reason for the fall in house prices and thus can rationalize it, making themselves feel better. So with this in mind, have we ever seen a decline in price similar to this without it being a bear market? Yes, we actually have. In 2004, Kensington saw a 14% drop in house prices before a 70% rally. And you can see this across the board if I just pull up central London again. One thing to note is that current sentiment is quite fearful. There is talk of further decline in 2024 and sellers are dropping listing prices. Now we'll dive into more analysis in a second, but this can mean one of two things. That either every single person is wrong because the majority of the time whatever the masses think is usually the incorrect answer and therefore it is a great time to buy, or we really are in a bear market and sentiment doesn't really matter until we get maximum fear and flush out all the sellers. The likelihood is that we are in a bear market already and we're already in a recession according to the SARM indicator, which we saw last week. Let's pull up Savills stock quickly. So yeah, so ever since 2022 August, when we got our indicator from Savills, the housing market has looked bleak. If you haven't seen that video, you can see it on our website, and I'll put the link to the website in the description below. Now, if we consider the Fed are going to cut interest rates into early 2024, this also increases the probability of a further crash in house prices. There, of course, is still, a glimmer of hope if we see certain things happen. However, with everything favouring further downside, it could be wise to ensure that if you are going to buy a home, that you have sufficient margin of safety. If you look at house prices and you wanted to buy a property, normally 20% is a fair risk tolerance because that's how far prices crashed in 2008 and 1989. However, with Kensington already seeing a 20% to 14% decline, it begs to differ how far or how big your risk tolerance should be. So if you're buying a standard home across London, I think 20% would be sufficient. However, once the bear market has started, nobody can really tell how far house prices are going to crash. You can use analysis, probabilities, you can use past recessions. However, nobody truly knows. So the best thing you can do if you are going to purchase a property, have that risk tolerance in place and make sure if you're moving into that home, you're going to be moving into that property for, 7 to 10 years. That's why, house prices may crash, but after the recession happens, by the time you come to sell, your house will be worth the same, if not more. So it's important to have that, 7 to 10 year outlook. A 20% buffer or safety margin of safety would be sufficient for standard properties because central London areas is where speculations runs rampant. They're like the blue chips, similar to the Magnificent Seven in the stock market, which hold up the entire economy. Let's look at a detached house in central London. £1 million, £800,000 is a pretty significant level of safety. You've got all this support in here as well. So yeah, don't quote me on this. You'd have to have a consultation either from myself or another property consultant to understand your situation a little bit better. Where should we go to next? Yeah, let's go straight to Savills stock. So you can see the 5-wave move here, which we touched on in the previous video. So as you can see, since the peak here, all we have seen realistically is lower highs. Lower highs, lower highs, lower highs. And I'm not sure if I mentioned it in a previous video or it's on Twitter or LinkedIn. However, this level of support looks like it could potentially break this time around. Because if you imagine this support is like a lake, every time you skim a stone on it, it has a higher probability of breaking. The level to really watch out for is down here. It's like level 745. I mean, we could potentially see a relief rally to fill some of these gaps. There's a gap here, and is there a gap up here? No, that's like a 61% retracement. It is possible, however, at the moment, very unlikely. We often speak about the 2025 to 2026 timeframe being when the 18.6-year cycle actually finishes. And if that's the case, you can see 10 to 20% parabolic gains in the last 2 years. However, unless Savills stock can break one of these previous highs, so it does something like this, and it comes back down, and you can see buyers and a short sort of time frame reversal in here, then you might see that rally. Unless this happens along with the S&P 500, which we'll go to in a second, probability still favors downside. And until you see this turn, it's too risky to be purchasing properties, because I'm not sure if you heard the saying, never catch a falling knife, because you get cut. Let's go to Barratt's Home Developments. And these are, of course, a home builder in the United Kingdom. And they obviously see lower highs as well, ever since January or February 2020. You have Taylor Wimpey. These are more everyday residential homes, not necessarily luxury. But this looks like a Wyckoff schematic. If we break a level sort of here, then this also looks dangerous. You have the UTAD up here. It doesn't look good. And you can see all these divergences. If we put Savills on stock, Savills on top. So at this point here as well, you can see a huge divergence. Between sort of this time period around here. So home builders obviously speculate in land prices and build homes. And when land is too expensive, they cut back on building because it's no longer profitable. So hypothetically, these you can see they move closely in tandem, and then these made a higher, whereas home builders didn't. So this is one of those times, just be cautious. Either sit on the sidelines, or if you have properties which you are looking to get out of, would be a good time. In September 2021 would have been a great time to start, listing your property, because you had until August 22 of house prices going up slightly or going sideways. We'll take a look at Bellway quickly as well, another UK home builder. You can see it's somewhat similar, and they was making lower highs, whereas Savills are making higher highs. So that divergence is, if you imagine it like let's say you have a car, and the car has to go along the track, and suddenly the road splits into two. The car can either go straight down the middle until the roads eventually meet again, or it can sort of follow one of the tracks until it eventually wraps around and it again meets. I know it's a bad analogy, however, that'll probably explain it the best. You can't pick both tracks. They have to meet and find that equilibrium and that balance eventually. As you can see, they're sort of divergent again here. One of these is wrong, one of them's right. One of the positive things is if you work in the real estate industry or you're selling homes, there's nothing necessarily to be worried about, especially if you're in the luxury markets, because humans purchase off of emotions. And if you sell homes or anything for that matter in a recession, as long as you pull on the emotional heartstrings, you will still be able to earn your commissions, etc. It's the same with any industry. So I'll bring this back up as well. There is a 78% chance of a recession. This cannot be ignored. And come December 12th or December 13th, we will have our answer. And if the Federal Reserve hold, then this statistic is cemented. So the next video, or the one after that, we will have a definitive answer. So be sure to subscribe for that one. Whilst we're here, let's look at the SPX. We haven't broke our level that we was watching out for yet. And we are sort of seeing some weakness already. However, these are the levels to watch out for. Dow Transportation Index broke that previous resistance level. So, you can't argue with the strength. You'd have to break this level around here, 14,730, in order for you to consider weakness. You can also look at the dollar index. If you break this level here, 105.54, you can consider these indexes to start falling down as well. Something to take note of. The yield curve hasn't uninverted just as yet. We can consider technology as well to be, and if you zoom out here, this really does look like a 5-wave move upwards. So this could be start coming to an end real soon. Your wave 1's here, your massive wave 3, the wave 4, and you can tell the difference between the wave 4 as well. This wave 4 is deep because the wave 2 would have been shallow, and they're normally the opposite of one another. So if the wave 2 is deep, the wave 4 is shallow and sidewards, vice versa. And this here, you can see the 5-wave move, 1, 2, 3, 4, 5. This could be the wave 3, and we can see some sideward action on one last thrust up, or we could have had it. This is starting to see weakness as well. It kind of looks like a Wyckoff schematic. And obviously, the tech sector holds up the majority of the market, along with Bitcoin. I think this deserves to be had a look at, actually. I mean, look at that. Ever since there was a MACD crossover here on a 2-weekly time frame, if you bought, you've been up 136%, which isn't bad for, a year's time. The major 7 are looking weak. Let's go to home builders though quickly. Home builders has made higher highs. If you zoom out again, you can see the 5-wave move here. And we're just finishing another 5-wave move. So, whilst it's exciting because we're making higher highs, we're coming to the end of this cycle. Sure, we can see some sideward action. One last thrust up. Do I think it's likely or probable? America's different to the UK's housing market. No, I feel like this is it. The UK's separate from America, of course, but even house prices over there, people are losing huge amounts of money and realizing losses. This is another interesting divergence as well that we'll have a look at. So you have the home builders ETFs. They look somewhat similar, and if we look at Savills stock on top of this too, you can see we've got a huge divergence here. So over time, they're somewhat similar. Yeah, they have a close correlation. However, this divergence is huge. Savills are making lower lows, and home builders in America are making higher highs. Because although the UK is technically in a recession according to a few indicators, America isn't yet. And of course, America has more gravitational pull because it's a bigger economy. One thing to note though is if we compare the 2006 divergence, but you can see home builders were both making lower lows, whereas Savills are making higher highs. And in this case, home builders in America was correct for the recession to happen. So if you were to take this consideration, you can make the argument that Savills stock is wrong and that it's going to start to rally upwards and get closer to home builders in America. However, again, this is unlikely. And if this is going to happen, we'd have to see some of these reversals on the S&P 500, and more importantly, you can watch Savills stock. But of everything with the yield curve, the 18.6-year real estate cycle, I can't see this happening. However, if it does happen, I'll make sure to update you on this page. I mean, I hope I'm wrong with my bearish outlook. That way, it makes certain properties risk-free to invest in. Because if we have the last 2 years of the real estate cycle, where we've seen them parabolic gains, so that's sort of 2006, I'll get a better example up here actually, 2006 until 2007, 2008, the peak, them gains were still 10, 20%, and they're somewhat, risk-free. Because if you do get a 20% decline, it was at the same level that you had got in at. However, but just watching Kensington alone, already seen a 20% decline, I think this house crash is going to be the worst we've ever seen. That cannot be ignored. And the level to watch out for would be around here at one point. Or terrace houses, let's go. Around this mark anyway. Because then that looks like a Wyckoff schematic. And then buyers could come back in potentially here. Because it breaks these support levels. Everyone sort of gets flushed out. But it's very possible we could go lower. Who knows? That's the question that nobody can unfortunately answer with conviction. I'll wrap this video up here. If you're still confused or would just like someone to look through all of this, boring stuff for you, reach out to us on our website and someone will get back to you at our earliest convenience. In the meantime, like and subscribe, and the next video or two will have a definitive answer, and if that 78% statistic, will come to fruition.